Welcome to the deep dive. Our mission today is, well, it's about cutting through that relentless noise in the financial news, trying to find the real signals for you. Because let's face it, the market right now, it's a lot. It feels like a flood of data, often pointing in totally different directions, makes it tough to know what actually matters. So today, we're diving deep into the U.S. financial markets as they stand in mid-2025. And what we're seeing is complex. A mix of signals, often contradictory, but really important to understand. We're going to unpack three key indicators: the Buffett indicator, the Shiller PE, you might know it as the CAPE ratio, and the VIX index. And you'll notice this tension playing out, these big long-term warnings about overvaluation bumping up against this surprising calm among investors in the short term. We'll get into what each one means, their track records, how reliable they've been historically, and importantly, how today's economy, which is different in many ways, might be challenging how we interpret them. Our goal for you, simple: to give you a more holistic view, help you see the forces at play, move past the headlines, and hopefully feel genuinely informed. Okay, let's kick things off. Let's start with a really big one, a metric Warren Buffett himself once called probably the best single measure of market valuations, the Buffett indicator. Sounds impressive. At its core, though, it's pretty simple, right? What's it fundamentally telling us? And how do we calculate it?
Yeah, it's conceptually straightforward. Essentially, it's asking, is the stock market's total price tag getting way ahead of the country's actual economic output? Think of it like a potential warning sign that things are getting overheated.
Yeah.
The calculation is simple, too. You take the total market value of all U.S. stocks and divide it by the country's annualized gross domestic product, or GDP. It's almost like a price-to-sales ratio, but, for the entire country. Market cap is the price. GDP is the sales. Okay, and based on that calculation, where are we right now? Because I get the sense it's telling a story. It is. As of June 30, 2025, the U.S. stock market value was roughly $65.47 trillion. Annualized GDP was about $30.15 trillion. Do the math, and you get, well, a Buffett indicator of 217%.
Wow, 217.
Yeah. And even a slightly more recent check, August 26th, had it around 213%. Still incredibly high.
And put that 217% in context for us. Historically, what's considered normal or fair? What's considered overvalued?
Historically, a range of maybe 75% to 90% is seen as fair value. Anything above 120%, you're already talking overvalued. So 217%, that's roughly 2.2 standard deviations above its long-term trend line.
Okay. And what label does that kind of reading get?
Starkly put, it suggests a strongly overvalued market. And what makes this indicator compelling, or maybe concerning, is its history. It has a track record of flashing red before major market downturns.
Like when?
Well, think back to the dot-com bubble in 2000. It surged up to the 140–160% range right before that crash. It also peaked before the great financial crisis in 2008, again showing this disconnect between the market and the underlying economy. And even more recently, in late 2021, it hit 202%. That was just a few months before the bear market we saw in 2022.
And now we're even higher than that 2021 peak at 217.
Exactly. Higher.
Yeah.
And there was a 2022 academic study that looked at this across 14 developed markets. It found the indicator explained something like 83% of the variation in future 10-year returns. So it's definitely a metric that commands attention.
Okay, that's a powerful history. But let's play devil's advocate for a second. The economy today isn't the economy of 2000, let alone 1987. With globalization, the rise of tech, does the Buffett indicator still carry the same weight? Are there criticisms we need to consider?
Oh, absolutely. And those criticisms are really important. You can't just look at the number in isolation. Critics raise some very valid points about its relevance today. A big one is the globalization gap.
Globalization gap. What does that mean?
It means GDP, the denominator, is purely domestic economic output, right? But the numerator, the market cap, includes companies that earn a huge chunk of their revenue internationally. For the S&P 500, it's around 40%. So you're comparing global company values to domestic output. It's a bit apples and oranges, and that could artificially inflate the ratio.
Right, I see. The sales figure doesn't fully match the price figure's scope. What else?
Well, there are also arguments about structural and digitalization shifts. The indicator might not fully capture the value of intangible assets, things like intellectual property, brand recognition, software, which are way more important today. And if the nature of the economy has fundamentally changed, maybe the old relationship between market cap and GDP doesn't hold quite the same way. It might understate the true size or potential of the economy in the denominator.
Okay, that makes sense.
And maybe most tellingly, even Warren Buffett himself has kind of walked back his initial strong endorsement. He said he's hesitant now to rely too heavily on any single metric, saying they aren't always comprehensive or consistent over time.
So the takeaway is, it's a flashing red light. Historically significant, but maybe with some modern static or interference.
That's a good way to put it. It screams overvalued, but there are asterisks. Important ones.
Okay. So the Buffett indicator points to long-term overvaluation, but with those caveats. Is there another long-term measure that maybe sidesteps some of those issues, like the globalization gap or accounting changes?
That brings us nicely to the Shiller PE, or the CAPE ratio. CAPE stands for Cyclically Adjusted Price to Earnings. It was popularized by Nobel laureate Robert Shiller, and it's specifically designed to smooth out the short-term bumps you get with a standard PE ratio.
How does it do that smoothing?
Instead of using just the last year's earnings, or expected future earnings, it uses a 10-year average of past earnings, adjusted for inflation. So you take the current market price, divide it by that 10-year average inflation-adjusted earnings. The idea is that a decade is long enough to smooth out the ups and downs of the business cycle, giving a more stable, long-term perspective on valuation. It tries to cut through that short-term market noise.
Makes sense. 10 years averages out booms and busts. So what's the KPE ratio telling us right now for the S&P 500? Given the Buffett indicator, I'm bracing myself.
Yeah, well, you're right to brace. The latest S&P 500 CP ratio is hovering around 37.78. Some sources might show it as 37.87, but it's right in that ballpark.
Okay, 37.78, and the historical average is?
The long-term historical average, going way back, is about 16.88.
So more than double the historical average.
Significantly more than double. This current level, around 37.8, is actually near the third highest point it's ever been.
What were the other times?
The only times it's been higher were right before the 1929 crash and during the peak of the dot-com bubble in 2000. Those are periods historically linked with what Shiller himself famously called irrational exuberance.
Okay, that's quite the historical company to be keeping. So if we zoom out, what does a KP ratio this high generally mean for investors looking ahead? Is it a short-term warning or more about the long haul?
It's definitely more about the long haul. The KP ratio isn't really about predicting when a crash might happen. Its strength lies in predicting long-term returns, say over the next 10 or even 20 years. Shiller's research, which goes back to 1881, shows this really consistent inverse relationship.
Inverse meaning high KP now equals lower returns later.
Exactly. A higher-than-average CAPE has consistently been followed by lower-than-average long-term annual returns. And the opposite is true, too. Low CAPE often precedes higher returns. We saw it play out after 1929, very high CAPE, followed by weak returns. Same thing after the peak in 1997-2000. That led into a decade where the S&P 500 actually had negative returns overall. And again, in 2021, CAPE hit its second highest point ever, 38.58. And that was followed by the 2022 bear market.
Is there a general rule of thumb with the numbers, like above X is bad, below Y is good?
Generally speaking, yeah. Historically, a CAPE below 20 has often led to better than average returns going forward. A CAPE above 30, that's usually pointed towards lower than average returns over the next decade or two.
So, like the Buffett indicator, it's another long-term warning flag about future returns being potentially subpar. But again, it can't be perfect, right? What are the counter-arguments or the criticisms leveled against the CP ratio?
No, it's definitely not perfect. And it has its share of criticisms. One common one is that it's inherently backward-looking. It uses 10 years of past earnings data to value a market that's supposed to be pricing in the future.
Right, the market looks forward, the indicator looks back.
Precisely. And then there are arguments, particularly from economists like Jeremy Siegel, that accounting rules have changed. He argues that changes in GAAP or generally accepted accounting principles, especially since the 90s, tend to underreport earnings compared to how they used to be calculated.
Ah, so if earnings are understated in the denominator...
the ratio looks artificially high compared to history. That's the argument.
Interesting. Are there other reasons people say, well, maybe a high CAPE is okay this time?
Yes, definitely. Some argue that today's environment justifies higher valuations. Persistently low interest rates, for one, make future earnings more valuable in today's dollars. And then there's the dominance of highly profitable tech companies in the S&P 500. These companies are arguably more efficient, have wider moats, and generate higher returns on capital than the average company of the past. Maybe they deserve a higher multiple.
Okay, so structural changes in the economy and market composition.
Exactly. And the other big criticism is practical. It's just not actionable for timing the market. Even if it's right about lower returns over the next 10 years, if you'd sold everything in, say, 1996 because the CPE looked high,
you would have missed a massive bull run for several more years.
you got it. You'd have missed huge gains. So it's a great tool for setting long-term expectations, maybe adjusting your portfolio risk, but it's a terrible signal for trying to jump in and out.
Okay, so we have two major long-term indicators, Buffett and KPI, both basically shouting about overvaluation and potentially muted future returns, albeit with some important modern caveats. Let's pivot now. Let's look at something completely different, an indicator that measures the mood of the market in real time. The VIX index, the so-called fear gauge. What exactly is the VIX telling us? How does it work?
So the VIX, officially the CBOE Volatility Index, is trying to capture the market's expectation of volatility over the next 30 days. It does this by looking at the prices of a whole bunch of S&P 500 index options, both puts and calls, across different strike prices. It gets called the fear gauge because, well, when investors get nervous about big price swings, they tend to buy options for protection, either puts to hedge against losses or calls to play potential upside volatility.
And that demand pushes up option prices.
Exactly. Higher demand for options means higher implied volatility, and that pushes the VIX calculation higher. So a rising VIX generally means rising fear or uncertainty. It's like a real-time pulse check on market anxiety.
Okay, pulse check time then. As of late August 2025, where was the VIX?
As of August 28th, the VIX was sitting at 14.43.
14.43. And give us the context. What do different VIX levels usually mean?
Generally, a VIX reading below 20 suggests a relatively calm, stable, low-stress market environment. Complacency, even. Once you get above 30, that typically signals heightened fear, uncertainty, significant market stress.
So 14.43 is remarkably calm.
Remarkably calm, yes. It suggests investors right now are expecting very smooth sailing ahead for the next month. Very little fear priced in.
Which is fascinating, right? Given the alarm bells from the Buffett Indicator and KP.
That's a huge disconnect, and this low reading raises that key question. How does the VIX actually play out historically? What's its main use? Its primary utility has often been as a contrarian indicator.
Contrarian meaning you do the opposite of what it suggests.
Kind of. Extreme spikes in the VIX, like when it goes way above 40, 50, even higher. That signals peak panic, absolute maximum fear in the market. But paradoxically, those moments of peak fear have often coincided historically with market bottoms. They've often been the point of maximum pessimism and therefore potentially great buying opportunities for investors with a longer time frame.
Buy when there's blood in the streets, even if it's your own. That kind of thinking.
Essentially, yes. Think about recent history. March 16, 2020, the depths of the COVID crash. VIX hit 82.69, market bottom shortly after. November 2008, height of the global financial crisis, VIX hit 80.86, again, near a major bottom. Go way back to Black Monday 1987. The VIX predecessor hit 150. Even more recently, that terrorist crisis scare in April 2025, VIX jumped to over 52. Market stabilized afterwards.
So high VIX equals panic, but often peak panic equals opportunity. Got it.
But what about the flip side? A low VIX like now?
Well, that implies complacency, but it's important to remember the VIX just measures the expected magnitude of price swings, not the direction. Ah, right. It doesn't say stocks will go up or down, just that investors don't expect them to move violently either way.
Exactly. It measures the expected size of the earthquake, not whether the ground will shift up or down.
Okay. But like the others, the VIX isn't a magic ball either, right? Are there limitations or criticisms here too? Does it always accurately predict the next 30 days?
No, not perfectly. One key characteristic is its mean reverting nature. It tends to eventually drift back towards its long-term average, which is somewhere around 19 or 20. It doesn't stay super low or super high forever. Also, studies have shown it often overstates the actual volatility that ends up happening in the following 30 days. It reflects fear, which can sometimes be more extreme than reality.
So it's more a measure of current psychology than a precise forecast.
That's the best way to think about it. Its real value is giving us that dynamic, real-time snapshot of market mood, of risk perception, rather than a perfect prediction of future price swings. It's a thermometer for sentiment.
Okay, let's pull these threads together. We've looked at the Buffett Indicator, the CAP ratio, and the VIX. And what really jumps out is this stark, almost jarring contrast. We have two major long-term indicators practically screaming, danger, overvalued, expect lower returns.
Yeah.
And then we have the short-term VIX indicator suggesting everything's fine, total calm, no fear. How do we reconcile this? What does this contradiction tell us?
It's a fascinating and, frankly, quite unusual situation. This combination of extremely high, long-term valuation metrics alongside extremely low short-term fear.
Yeah.
It really brings to mind the work of Hyman Minsky.
Minsky, the financial instability hypothesis.
Exactly. His core idea was that periods of prolonged stability and low volatility, like we're seeing with the low VIX, can actually breed complacency and excessive risk-taking. That stability itself can sow the seeds of future instability. So in this context, the very low VIX might not be a sign of genuine safety. It could actually be a red flag, a sign of a complacent market that's ignoring the underlying valuation risks highlighted by the other indicators.
So low VIX plus high valuations could equal dangerous complacency.
That's certainly one interpretation. It might be fueling a sense of this time is different or irrational exuberance that could make the market vulnerable if something disrupts the calm. So just to quickly recap the dashboard, Buffett indicator near 217%, warning, long-term overvaluation, Shiller PE near 38, warning, poor future long-term returns, VIX near 14, signal, market complacency.
Wow. Okay. So putting all that together, what does this mix of signals mean for the bigger economic picture? We've heard so much talk about a potential soft landing after the Fed hiked rates aggressively. Where does this fit in?
Well, it adds another layer of profound uncertainty to that whole debate. One classic recession indicator is the inverted yield curve when short-term Treasury yields are higher than long-term ones. That's historically preceded every U.S. recession since World War II.
Right, and the curve was inverted for a long time. Where is it now?
As of mid-2025, it is actually uninverted. But historically, the recession doesn't always start during the inversion. Sometimes it comes a few months after the curve uninverts, following that prolonged period of inversion. So that historical signal is still kind of ambiguous, maybe even leaning towards caution.
Okay, so the yield curve is tricky. What about other economic data? Is it painting a clear picture?
Not really. It's pretty conflicting right now. On the one hand, supporting the soft landing idea, Q2 corporate earnings for 2025 were surprisingly strong. About 82% of S&P 500 companies beat expectations. Tech, in particular, boosted by AI investment, looked robust. And crucially, the Fed has pivoted and is now in a rate-cutting cycle, which usually helps the economy.
Okay, points for the soft landing. What about the other side?
Well, the labor market is showing signs of softening. The July 2025 job report came in lower than expected, and job numbers for the previous couple of months were revised down significantly by a combined 258,000 jobs. That suggests the economy might be losing momentum.
So strong earnings, but a potentially weakening job market. Add in the conflicting market indicators. It really is a picture of uncertainty.
Deep uncertainty.
Yeah.
And it circles back to that fundamental question. Is the modern economy, with globalized tech giants and maybe different inflation dynamics, truly different this time? Do these high valuations make sense now? Or is history right? Is a reversion to the mean, meaning lower valuations and potentially a correction or tougher economic times, inevitable? That's the multi-trillion-dollar question these signals force us to ask.
And nobody have a crystal ball.
Absolutely not. And that's why trying to perfectly time the market based on any single one of these indicators, or even all of them, is so risky. History is littered with people who tried and got it wrong. The smarter approach really is to use these indicators together as more of a holistic compass, to gauge the overall level of risk in the market, to understand the long-term probabilities, and maybe adjust your strategy accordingly.
So what's the compass pointing to now?
Right now, the collective signals strongly suggest that caution is warranted. Not necessarily that a crash is imminent tomorrow, but that the odds for generating high returns over the next decade are historically quite low based on current starting valuations.
Right. With KP predicting low long-term returns and the Buffett indicator screaming overvalued, it underscores the need for that disciplined, diversified, long-term approach. This doesn't seem like a market environment for chasing quick gains.
Precisely. It feels like the market might be priced for perfection. And if those perfect conditions don't materialize, if earnings stumble, if inflation resurges, if anything unexpected happens, the lack of a fear buffer, shown by the low VIX, could mean volatility returns quickly, leading to corrections.
And for listeners who do want to keep a closer eye on one of these key metrics, you mentioned the Buffett indicator. There's actually an app for that, right?
That's right. If you're interested, you can search for and download the Buffett Indicator iOS app from the Apple App Store. It helps track that total market temperature we discussed.
Good to know. And of course, the usual disclaimer applies here.
Absolutely. Everything we've discussed today is based on publicly available data and analysis. It can be subject to revision, different interpretations, and most importantly, this is all for educational purposes. It is not investment advice. You absolutely need to do your own research and due diligence before making any investment decisions.
Well said. And if this discussion has piqued your interest in diving deeper into value investing principles, please do subscribe to our channel, Deep Value Investing, on Apple Podcasts or Spotify. We've also put together a list of recommended value investing books, which you can find in the episode description. So let's leave you with this thought to chew on. We have these historical indicators suggesting we're in, well, uncharted territory valuation-wise.
hmm
Does that mean the old rules genuinely don't apply anymore because the economy has fundamentally changed? Or are we perhaps more vulnerable than ever to the oldest rule of all that market sentiment, currently so optimistic and calm, can flip on a dime, shifting from that complacency to something much, much more cautious? What stands out most to you in this complex, contradictory market landscape? Something to think about. Thanks for joining us on The Deep Dive.